And joining us now on the program, pleased to have back with us Mac Marshall. He is the Senior Vice President of Market Intelligence with the U.S. Soybean Export Council, as well as the United Soybean Board. And Mac, it's been a little while, but glad to have you back on the program. How are you, sir?
I'm doing great, Jesse, and it's fantastic to be back on the program. We got a lot to cover today.
We do have a lot to cover, Mac. Let's jump right in and focus first on the acreage and quarterly grain stocks numbers from USDA that came out on the 30th. And I think, for starters, a lot of folks were surprised by that soybean acreage number. And I'm wondering your thoughts on that number from USDA and how that plays into just the soybean market in general, Mac.
Well, I was surprised by it as well. I didn't expect this to come down to 88.3 million acres, which was even below the low end of the range that the trade was generally looking at. I think this year, in any given year, you're always going to have some cropping shifts between the end of that March 31st report and then the end of June report, just as farmers are making, last minute decisions on the margins. But, this year, I think, was presenting a acute set of challenges. One, certainly input price pressure, input availability that can have an impact on those last minute cropping decisions. I mean, if you don't have nitrogen available or the right type of fertilizer or the chemistry, that's going to dictate what you can actually get in the ground. And then of course we had the further confounding factor of a very late start to planting in many parts of the country, a lot of cold and wet weather throughout the northern plains. USDA actually mentioned in their release today that they would be resurveying a number of crops, soybeans included, across the Dakotas and Minnesota. So we'll really get more of a truing up of acreage in that August 12th crop production report, which is always has some fireworks because you typically see some yield adjustments there as you bring in the first survey-based yield adjustments. But you overlay that with some acreage changes, and then that sets up, I think, for a pretty interesting report day in a couple weeks. But at least standing on where we are today, that soybean acreage number, took the trade a little bit by surprise. But the price response didn't really line up with that. We saw, at least in the early hours following the report, we've seen old crop beans up a little bit, and then new crop beans really down across the curve there. So the question is why? Well, that's where you have to look at the other half of the reports that came out today and look at the grain stocks. Now, basically, with quarterly inventories, I think at about 970 million bushels, that was really right in line with what the market was expecting, which even with it matching those expectations, and I think providing a little bit of bearish sentiment in that regard, or at least relative to what the market was expecting. I think we also have to, look at what the implied usage is by that quarterly stocks figure, and that is a very bullish signal to me. If you look at that March through May quarterly disappearance figure, reconciling basically the difference between those March 1 inventories and those June 1 inventories, it was about 960 million bushels, I believe, which is a record pace of utilization for the March, April, May quarter. So overall, we're in a backdrop of really strong demand for U.S. soybeans. We've been seeing some really strong crush numbers overall. We've also seen some really counter-seasonal strength in our export campaign program. So really the backdrop of demand is quite strong here. One thing I want to reconcile as well, because anytime you have a major revision to that area figure, and it's basically in the order of a drop of 2.7 million planted acres relative to the end of March. You put that together, you reconcile it against trend yield, which USDA right now is using a yield of 51.5 bushels to the acre, and it's effectively taking off about 130 million bushels of production from the projected balance sheet. Now, again, that's all trend yield. What's in the ground now has to propagate in advance, and we have to get into the key stages of crop development to really have an assessment on that. Again, part of the reason why that August 12th report is so important. But even with that 130 million bushel notional reduction, we're still looking at, again, with trend yield, a record crop of 4.5 billion bushels. But, you take 130 million bushels off of the supply side of the balance sheet, and we'll be looking at and already with a tight carryout position.
Mhm.
That doesn't give us a lot of wiggle room in the balance sheet, for this next year, which I think is part of the reason with even though we've got, basically a $2 spread between old crop beans and new crop beans, those new crop bean prices are still very, very strong. But of course, that's not to say that that means, high degree of farmer profitability, because again, we have a lot of input cost pressure. And even with those high prices, we're seeing a lot of compressed margins around the country.
Very true. Well, and you led me right into what my next question was going to be. We look at these numbers and we know we have a tight carryover right now, Mac. And I know there's been some chatter out in the trade, looking at these numbers. I mean, if we don't get that trend yield, what's that going to do? Because, like you said, there's not a lot of wiggle room here to have any error. I mean, we could be talking, closer to some pretty historically low levels of soybeans, Mac.
Yeah, no, last season I would reference the 13-14 marketing year as somewhat of an analog year, because that was the last time that we saw, $14+ beans. We had a carryout of under 100 million bushels, stocks to use ratio under 3%. Right now, we're at a projected stocks to use ratio for the end of this marketing year, I think about 4.6%. So, again, very, very tight. We'll be coming into the season with relatively tight inventories. I think some growth relative to last year, but still tight overall. And the question is, what does it mean over the course of the new marketing year? Now, if you recall back in May and June when the USDA issued their new crop, full balance sheets, taking into account the demand side of the equation as well as production, those were also looking at tight carryout for the balance of the 22-23 marketing year. So if we have any hiccup in productivity, take that yield figure down again. If that were to unfold, that certainly tightens up the overall picture again, and we could be looking at something closer to 13-14. But again, it's still early. It's June 30th when we're recording this, the day of the market release, and we have to see the way the crop progresses. We've had a couple crop condition reports come out. I think we're on week 3 or 4 of that, and the crop is still, is in a favorable position relative to last year. I think where we are right now is at a 65% good and excellent rating. 65% of the crop is rated good, excellent, and compared to 60% last year. And of course, last year, even as we had a lot of drought pressure throughout much of the year, we still wound up producing a record crop of 4.435 billion bushels. So, crop conditions overall looking good.
Mhm.
But of course, there's a lot to still figure out on the supply side of the balance sheet, not just the crop production side in terms of yield, but also what that true area figure is going to be when we have those resurveys across the Northern Plains in Minnesota.
Well, and you mentioned as well the good crush margins, and I know we've seen the meal market fairly strong to wrap up the month of June. And we think about exports as well, and competing with countries like Brazil and Argentina, for that Chinese business and some of those other big soybean importers. What's your thoughts with the product market and with exports right now as we head into the month of July, Mac?
Well, let's start with whole beans. We're at a point in the year where typically Brazil has kind of reached its seasonal peak and is trending down, but is still the major supplier to the world, and that's still true. But with the shocks to the South American crop this last year, basically across Argentina, Paraguay, and Brazil, the world was looking at a expected crop size of over 200 million metric tons. It probably came in, closer to about 170 million metric tons. So we've got double-digit declines across each of those countries in percentage terms. As that has come off the balance sheet and reduced the export viability from Brazil, we've seen some seasonal or counter-seasonal purchasing from a lot of buyers overseas at a point in time when you don't typically see a lot of strength in U.S. exports. I'd say the pace of seasonal purchasing this season relative to last season is very different. In the 2021 marketing year, where of course we wound up with record export campaign for both whole beans and the whole beans meal oil complex. A lot of that was really front loaded, a lot of aggressive selling and exportation early on in the marketing year, so that when we got to this point of the season, where we've got just a couple months left in the marketing year, there wasn't a lot of availability to make it out into export channels. Now, going back to the stocks report, June 1st inventories for 2022 up 26% relative to 2021. So part of that is reflective of a seasonal export pace, which has been a little bit more smoothed out rather than being front loaded in the early part of the marketing year. So what does this all mean? Well, if you look at the export pace figures that come out every week, we're seeing, counter seasonal strength for much of the year. We've been kind of tracking along with the 14-15 marketing year, a good year for exports, not a banner year. And now in the latter half of it, we're starting to see some upward, motion in that in that trajectory of export that really could potentially put us in line to have the second or third strongest export campaign for whole beans, trailing only last year. USDA has continually revised up its export expectation in the last couple WASDs. So with that, there's certainly an opportunity to continue to advance there. For meal and oil, certainly seen a lot, some resurgent strength in meal markets. Our meal export pace continues to be strong overall, and that's meal is doesn't have a huge degree of seasonal factors in terms of export pace. It's really pretty steady throughout the balance of the year, 200 to 300,000 tons per week, and that continues to be strong overall. On the oil fraction side, we've seen a lot of movement over the last 5-6 weeks, where oil prices have come down from reaching upper 80s. I think it peaked at about 88 cents per pound in mid-May, and has come down. I think right now it's trading for about 71 cents a pound, and that is really kind of reflective of not things that are intrinsic to the soybean oil market, but really the global veg oils complex. Remember, palm oil is the most globally traded and exported vegetable oil, certainly in volume terms. And over the last couple weeks, the major producers in Malaysia and Indonesia, particularly Indonesia, have been figuring out what their export quota program is going to look like. We've got a lot of food inflation. Certainly we see that in the United States, but in a lot of developing markets, that escalation in food prices is pretty detrimental to overall food security. So governments are taking initiatives to quell domestic price inflation. And one of the ways that some markets do that, and the way that Indonesia had initially approached it, was to initiate export quotas and to keep more of what would be going out into the international market back within the country. Now, what that did is had the unintended consequence of making it so that the plantations there weren't able to continually offload palm and palm oil. You basically led to this buildup of inventories locally, started depressing the overall palm oil price. And then once markets are starting to absorb that Indonesia is recognizing this, starts issuing higher volumes of export permits. The market starts to absorb that, and then you start to have a sell-off in palm oil as well. So you've really had palm take a tumble. I think it's down 22% on the month. And when you have a strong price movement for one of the major oils, and those being palm, rapeseed/canola, sunflower, and of course soybeans, when you have aggressive movement one way or another for one oil, you typically have a knock-on effect with the others as well. So you've had palm kind of leading the complex down over the last few weeks, and soy has been trailing behind it. But we've seen a little uptick in soybean oil prices over the last week or so. Overall, oil prices are, and I'd say the overall recognition of the value of oil is at a fundamentally different place than where it was a couple of years ago. Yeah. And with that, you're seeing crushers adjust. Again, those margins are overall looking strong. Crushers across the country are really trying to extract more and more oil out of it, out of each bean, or out of each bushel of beans. If you're looking at a 60 pound bushel of beans, historically, crushers been able to get like 11.5 pounds of oil out of that. Well, for 2022, at least through the first through May, those extraction rates have crept up to 12 pounds per bushel. So, recognition that strong value of oil is an increasingly important value driver for crush. And processors are responding accordingly and trying to get more oil out of it. So we're in a very interesting position for the soy industry and complex, where there's strong values overall for both sides of the co-product equation in terms of meal and oil, and that's really kind of helping keep enterprise values high here.
Very true. Well, Mac, great stuff as always. Real quick before we run out of time, any final thoughts you have for us today?
Well, it's we said this last year, but I think it's equally true this year. It's going to be one heck of a weather market over the balance of the year. We've already seen some pretty aggressive movement on both sides, up and down, over the last couple of weeks when we've had those condition reports come out. And the reason we're in a strong weather market here, or one that is going to really kind of carry a lot of price movement, is that we're in a tight overall inventory position where, as you said earlier, there's just not a lot of wiggle room. So, keep watching the boards, keep watching the fields, and we'll keep progressing through the balance of the growing season, and hopefully come away with a very strong crop at the end of the year. Because our farmers are always looking to produce, and the world is really clamoring for some relief in those balance sheets, and a strong U.S. crop to hit the market in the fall.
I couldn't agree more. We'll be watching things very closely, and we'll have to get you back on again real soon here, Mac. We appreciate the time. Thank you for joining us today here on Market Talk.
Thanks for having me, Jesse. Can't wait to be back on.
With that, Mac Marshall, Senior Vice President of Market Intelligence with the U.S. Soybean Export Council and United Soybean Board. I'm Jesse Allen. Have a great afternoon.